Hello and welcome to LOLC Securities Weekly Market Roundup. I'm Tharithu Amarasekara.
And I am Megara Vijayamana. This is the sound of profitability. The Sri Lankan Customs achieved its monthly target for the sixth consecutive month, where in June it achieved its target way before the end of the month. Customs has set a revenue target of 2,207 billion rupees for this year, 13.5% less than last year, as it originally expected a significant decline in car imports. Data showed it achieved 60.8% of this year's target of 1,342.6 billion rupees even before the end of 6 months. Last year, Customs collected a record 2,551 billion rupees in revenue, exceeding an upwardly revised target of 2,241 billion rupees for the year and achieving 64.2% higher revenue than the previous year's revenue of 1,553 million rupees. Sri Lanka's customs revenue jump is largely due to stronger enforcement, improved valuation practices, and a rebound in import volumes after years of contraction.
In a notable policy reversal, the NPP government led by President AKD has decided not to implement a key VAT amendment that was announced in the 2026 budget. The initial plan to drop the VAT registration threshold from 60 million rupees to 36 million rupees has been discontinued as it was initially scheduled for being implemented from the 1st of July.
The NPP government's decision to abandon the VAT threshold reduction illustrates the complex interplay between economic reform, political reality, and social impact in Sri Lanka. While broadening the tax base remains essential for long-term fiscal stability, the government has prioritized protecting vulnerable businesses in the short term. The amendment included in the VAT bill, gazetted in late April, sought to broaden the tax base by requiring more businesses to register for VAT and the Social Security Contribution Levy. The Parliament Committee on Public Finance last week exposed the unpreparedness of the government as state officials struggled to respond to questions raised by the panel members. Previously, businesses with annual takeover exceeding Rs 60 million were required to register. The new threshold would have brought thousands of medium and small enterprises into the formal tax net. The stated goal was to increase tax revenue, reduce distortions between registered and unregistered businesses, and support fiscal consolidation.
Sri Lanka's goods and services exports expanded by 18% this May 2026 to $1,570 million, according to data showed by the Export Development Board. The merchandise exports in May 2026 amounted to $1,223.5 million, reflecting an 18.3% increase compared to May 2025. The services export earnings recorded $347.2 million in May 2026, with an increase of 18.7% compared to the same period last year. In total, Sri Lanka's exports for May 2026 reached $1,570.6 million, recording a 18.3% year-on-year growth compared to May 2025.
Time for the corporate highlight with Megara.
Sunshine Healthcare and Zydus Life Sciences will build a pharmaceutical manufacturing facility at a cost of over $20 million in Sri Lanka through a joint venture company called Zydus Sunshine Life Sciences Pvt Limited. The plant will focus on manufacturing pharmaceutical products for Sri Lanka's retail market by improving access to high-quality medicines while supporting national supply chain resilience, according to a joint statement by the companies. Strong local capabilities are key to resilient healthcare ecosystems. By combining Zydus's global experience and manufacturing excellence with Sunshine Holdings' local expertise, this collaboration marks an important step in strengthening Sri Lanka's healthcare ecosystem and building sustainable pharmaceutical capabilities for the future. This was a statement by Sharvil P. Patel, the Managing Director of Zydus Life Sciences. The joint venture combines Zydus's global expertise in pharmaceutical manufacturing with Sunshine's local market presence and healthcare distribution capabilities. Here is Tharidu with the ESG updates.
Europe's heatwave endurance continues as multiple countries are set to embrace triple-digit temperatures. Many countries, including the UK, have already seen the highest recorded temperatures falling over multiple different days as Europe is hit by one of the worst heat waves in its history.
Temperature records were broken across the continent again, including Germany, Poland and Czech Republic as the extreme heat continued to move east. In a post on X, the WHO chief, Tedros Adhanom, said that more than 1,300 excess deaths had been recorded since 21st June linked to high temperatures in Europe. On Sunday morning, France's National Health Ministry said there had been around 1,000 more deaths than expected in the country since last Wednesday. Many of the extra fatalities are among those aged 65 and over, the agency said, after logging a 40% rise in the number of people dying at home.
Time for a look at what's happening around the world of business with the international highlights.
US consumers are still spending, but inflationary pressure is eroding the real income growth and narrowing the cushion behind consumption, according to a new Fitch Ratings report. Lower oil prices could ease the squeeze if sustained, while stable labor market conditions and solid balance sheets should keep the slowdown contained but uneven through the second half of 2026. Real consumer spending growth eased to 1.4% quarter-on-quarter annualized in Q1 of 2026 after averaging 2.6% in 2025. Stronger May retail sales point to near-term resilience, but inflation-adjusted spending power remains under pressure and consumption growth is still likely to slow. Fitch expects consumer spending growth to slow to 1.7% in 2026. Income trends are a drag. Nominal disposable personal income growth slowed to 2.6% year-on-year in April 2026 from 5.1% a year ago, while real disposable income fell by 1.1% year-on-year from 2.8% a year ago. Consumer Price Index inflation rose to 4.2% year-on-year in May from 3.8% in April, and Fitch has revised its end 2026 CPI forecast to 3.7% from 3%.
The Strait of Hormuz has seen more traffic in the past 1 week than the last 3 months ever since the war between US and Iran has started. However, that may begin to slow down as the critical evacuation plans are put on hold as tensions rise again.
73 vessels transited the critical waterway on Wednesday last week, the highest number since shortly after the war with Iran began in late February, according to marine traffic. That's more than double the traffic from the previous day. The spike in traffic comes after US lifted sanctions on Iranian oil earlier this week, part of the ceasefire agreement between the two countries. The United Nations and the International Maritime Organization, or IMO, also launched a humanitarian effort to get 11,000 stranded seafarers and 500 vessels out of the strait. Before the war, experts estimate 110 to 160 vessels used to sail through the passage between Iran and Oman daily. Since the fighting choked off the strait, an average of fewer than 10 vessels per day have transited the 21-mile passageway.
And that's it for LOLC Securities Weekly Market Roundup. As always, no matter what investment decision you make it with the right intent. We will see you next week.